It is graduation season, whether that be from high school or college or what have you. The reason I know that it's college graduation season is a bunch of the relatives are in town this Sunday, and that must mean then that one of the three boys is graduating from somewhere, and that would be the youngest, Connor, graduating from Boone High School this weekend. So we thought it would only be appropriate, given it is graduation season, to talk a little bit about student loans and student debt and all of those kinds of things that go, sadly, with graduation in today's world. For that portion of the program, we're going to be joined by one of our fellow certified financial fiduciaries here at Nelson Financial Planning, Garrett Fields, fresh off of a television interview that he did last week, or maybe it was the week before, talking about this very same subject. So he will be joining us later in the program. Welcome, of course, to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries like Garrett Fields stands ready to help you this week change your life with a successful and cost-effective financial plan. So before we get to the topic of graduation and student loans and student debt and all that kind of stuff, obviously, we would be remiss not to spend the opening segment like we typically do, talking a little bit about the week that was. Certainly a very tricky week for the markets. A lot of volatility. Monday down, Tuesday up, Wednesday. It just was a pattern that at the end of the day, you needed to have a pretty thick stomach for it if you were tracking your balances on a hourly or daily basis. And I guess that kind of underscores the conversations that we have with our clients, and for that matter with our listening audience here on the radio program and podcast. You know, it's one thing to sort of get so transfixed on these daily movements. It's another thing to make sure that you're maintaining some level of perspective. I think sometimes you hear the general notion of, well, maybe it's not necessarily a good time to check out those account values. And I think there's some wisdom and logic to that. I've certainly said that personally in jest to many folks over the years. But I think that doesn't mean you stick your head in the sand. And I think that's where sort of that difference is, because at the end of the day, you certainly do want to sort of check in and see, okay, what's going on? How's it impacting me? And am I going to be prepared or okay for the road ahead? And I think the tricky part is if you're doing that, and you're doing that during a highly emotional time, that's where you've got to be, that's one of those points in time where you've got to be really careful about making broad-based decisions as it relates to your investments, your retirement, and your portfolio, particularly during periods of high emotion. And I guess when you stop and think about that little piece of advice, that's probably advice that you could use across the board in life, no matter what we're talking about, right? I mean, how many times have you heard making an emotional decision, whatever it might be, is not really going to lead to the best decision? And you would certainly say that that applies to your investments and your portfolio and your retirement. But it's never bad to just sort of take stock and drill down and just confirm, hey, what is it that I own when I look at my investment portfolio? Maybe it's a bunch of stocks, maybe it's a bunch of bonds, maybe it's a bunch of combination, maybe it's mutual funds, maybe it's ETFs, whatever the case may be. We think it's important to maybe take and get some perspective. Make sure you've got that perspective on what it is that you own. Drill down a little bit. Okay, great, it's a bunch of funds or ETF, a bunch of stock, but what does it really represent in the aggregate? And I think it's important to particularly look at that aggregate picture, because that will give you an indication of, okay, well, I've got some stuff that is perhaps in the market, maybe some stuff that is all this tech stuff that, did well over the past many, many years, but now it is going down disproportionately to the rest of the market. Maybe I've got some in cash or in short-term bonds, or maybe I've got some in longer-term bonds. Maybe I've got some in smaller companies. Maybe I've got some in international. It's important, I think, to take a step back and just get that perspective of, okay, what is it that I own and what does it look like in terms of percentage terms? And I think far too often we think of, I've got a growth portfolio, I've got a growth and income portfolio, or I've got an income portfolio. But it's more important, particularly in days like now, to have a deeper understanding. What percentage is in stocks? What percentage is in bond? What percentage is in cash? What percentage is in large companies versus small? Growth companies versus value? Long-term bonds versus short-term bonds? And I think if you have that perspective, then you're going to have a little bit better understanding or appreciation of what it is that you own. Our bias, if you listen to the program at all, our bias is always going to be towards larger companies, owning those companies that are the industry leaders in their particular sectors, the kinds of companies that make the stuff that the world uses every day. And I think from that perspective, if you have that perspective, you start to bring a little bit more into focus of, okay, well, what is it that I own? Balanced growth, technology versus value, dividend. Certainly, that is an important consideration, and one that we've been talking about on the program for a long time now. Low interest rate environment, great for growth tech companies. Not so good when interest rates go up, and we're certainly seeing that in the market. And then one last thought, if you will, and I think this is why it's important to kind of drill down and see, okay, what do I have, what's the mix, and what's the types of holdings that I have? Because at the end of the day, and we like to remind people of this on a regular basis, you accumulated your investment portfolio, you accumulated your retirement portfolio over a period of time. Guess what? You're not going to spend that portfolio all in one day. You're going to spend it over a period of time. And I think that's the piece that people kind of forget when they're looking at their balances during particularly volatile periods of time like what we're in right now, where they're seeing the numbers shift, but they're losing perspective of, okay, well, how did you get there? How did you wind up accumulating that money? We accumulated over time, right? It wasn't just one shot deal, or maybe if you were fortunate, you won the lottery or something like that. Congratulations on that, by the way. But the reality is that you accumulated, vast majority of people accumulate that over time. Correspondingly, you're going to spend that over an extended period of time, right? Think back over the past 30, 40 years, if that was the period of time that you were accumulating those assets, what did you run into? Well, you ran into 9/11, you ran into a tech bubble, you ran into a financial crisis, you ran into a lot. Similarly, over the next 20 years, yeah, you're going to run into a lot as well, but you accumulated over time. Make sure, remember, you're spending this over time. And in that regard, there's pieces that are available now that you could utilize that haven't had the kind of volatility as the overall market. We're going to take a break. When we return, we'll continue the conversation here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Talking a little bit in that last segment about the volatility in the market and sort of what the perspective needs to be. Remember the key piece that we were saying there at the very end of that segment. When you drill down and get an appreciation of what it is that you own, and that's the kind of thing that I think is a wise exercise to do right now, rather than get too fixated on the actual numbers per se, have an understanding of what it is that you own. And at the end of the day, you should see that there's different parts of the portfolio doing different things at different times. That's the notion of diversification. If it's all in large tech, well, then you haven't been listening to this program very well. You should be diversified and have different pieces that hey, at any given point in time, there's pieces of my portfolio that I know that I can grab or utilize if I need to that have less volatility than the overall markets. Remember, you accumulated that money over time. You're not going to spend it all in one day. You're going to spend it over time. And I am sure over the next 20 or 25 years that you're going to see a host of headlines, not unlike what you saw while you were accumulating that money along the way. So certainly some things to think about. What's interesting is when we pan the camera back and take a look at some of the other asset classes that are experiencing a high level of volatility, the fringe asset classes, if you will, the crypto, the NFT stuff, all of that, the numbers in terms of the declines are just nothing short of staggering, if you will. And so we wanted to just spend this segment of the program talking a little bit more about a development on the crypto side of things that we were talking about last week on the program. That notion that Fidelity is suggesting that it's going to start to offer crypto as part of its 401k platform. To repeat our view, if you will, on that from last week, and by the way, it's a view shared by the Department of Labor, crypto obviously highly speculative. We think that that is just one more example in the history of examples that we've seen over our career in the financial services industry, where the financial services industry, rightly or wrongly, actually has a pretty good marketing arm, and we see time and time again where the industry itself leans into or starts to offer products at the worst possible time. I think back to the late 90s where everybody was rolling out a tech fund or an internet fund, a dot-com fund. Pretty sure I remember that not playing out particularly well. Fast forward to 2007, a lot of real estate stuff coming out, mortgage, all of that, that didn't play out very well either. So when it gets to the point where you hear the financial services industry starting to offer products in formats that they haven't offered before, well, then you may want to take stock of that and come quickly to the conclusion that it usually means a not so good time to be getting engaged in that. And again, why? Because that's where the dollars were flowing. Interestingly, though, how quickly those markets have changed. So we got some interesting stats for you here that we'll be talking about in this segment in the program. So we want to welcome our listeners, of course, across Central Florida. Of course, we're on a variety of radio stations throughout the Central Florida region. This, of course, is Dollars and Cents, where we also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you check us out on your favorite podcast or social media channel of choice. Make sure you're subscribed to us as well, and then that way you know when we upload new content, you'll be the first to know when we do that. My name, of course, Joel Garris. I'm a certified financial planner and certified financial fiduciary at Nelson Financial Planning. So to recap, if you've missed it in previous programs, the view sort of on the crypto side of things, what makes it so speculative is just there are three things I think that would raise an eyebrow, if you will. And first is the lack of track record. It's funny, a lot of folks that are big fans of crypto would say, it's going to be an inflation hedge or it's going to be a hedge against the markets. And the problem is, though, it's actually been quite the opposite. As you've finally had a period of higher inflation, it has not held its value, and correspondingly, it certainly has gone down quite a bit more. I think down 54% since November. That's over double what the decline is, triple what the decline is in certain, if you compare that to the S&P 500. So much more speculative, much greater downside. And at the end of the day, as we've always said, number two, nothing to show, if you will. Its value is what somebody says it is. So when there's no barriers to entry, this would be number three, with 8,000 at last count, the process is not that difficult to make. Those three things combine it to make it highly speculative. And if you thought that wasn't enough of an example of how speculative asset classes, when interest rates go up, perform poorly, consider NFTs, non-fungible tokens, the thing that everybody was rushing into, even more bizarre, if you will, than crypto. These are digital tokens. Digital tokens, almost like digital baseball cards, for lack of a better description, except it's not an actual baseball card. It's like a digital certificate, if you will, that act like a certificate of ownership. So it's like I've got a digital record that I own this thing. And oftentimes they were with pictures or prints or screenshots or whatever the case may be. The market in those collapsing at dramatic levels. Total average sales, I'll give you these numbers, down 92% since September. The NFT of the first tweet from Twitter founder Jack Dorsey sold in March of 2021, so that's just over a year ago, for $2.9 million. You know what the maximum offer is on that today? $14,000. I mean, that is a complete collapse in value like none others. Because why? Because there's no barriers to entry. Much like we were talking about with crypto, no barriers to entry means that it's a flooded market. So for every buyer, there's approximately 5 NFTs out there. That's a very, very flooded market. Once again, a great reason to not suspend common sense when it comes to investing. The collapse of NFTs, the collapse of crypto markets is once again proof that history has a long period in it that shows these kinds of more speculative assets that require you to suspend your common sense, that require you to suspend your beliefs, just never really pan out. And by the way, it's nothing new. It's been going on since the 1600s. If you look at the Dutch Golden Age and you look at tulip bulbs in the year 1634, there was a major acceleration in the value of tulip bulbs all the way up to the collapse in February of 1637. We've seen it. Why? Because at the end of the day, it's a tulip bulb, right? It's not actually like going to be worth a crazy amount of money. But much like they did back in the Netherlands in the early 1600s, you saw a speculative bubble. The first, if you will, or I guess that's the first recorded one in history, but there's been plenty more since. And when it comes to crypto and NFTs, you might very well be seeing that exact same thing play out. Certainly on the NFT side, that's even more dramatic. First, stuff that sells for $2.9 million just over a year ago, now only worth about $14,000 based upon the current market. That's a pretty significant decline when it comes to what can happen with speculative assets. The reality is, though, at least with a tulip bulb, you actually might have had a nice pretty flower. With an NFT, I don't really know what you have, except for some digital certificate, which, you know, whatever, because you don't actually own the art. It's anyway. So some interesting numbers that are playing out just across the board. Again, as we see easy money getting pulled back from the economy, you're seeing these major shifts within a broad period of time. So we're going to slide to the break. When we come back from the break, we're going to start off with a conversation about what the Wall Street Journal calls the taxpayer con of the century. Coming up next with our associate Garrett Fields here on the program Dollars and Cents. Welcome back to the program. The Wall Street Journal calls it the taxpayer con of the century. I thought it only appropriate to start off a conversation about student loans, student debt, particularly in the midst of graduation season, with the Wall Street Journal opinion piece. Did you see this opinion piece, Garrett?
Oh, this had some interesting information on it for sure.
Aptly titled. Of course, we welcome Garrett Fields to the program. He's one of our fellow certified financial fiduciaries at Nelson Financial Planning. You just did a TV interview, actually, on the student debt and student loan stuff. Tell me a little bit about that.
I did. So this was interesting timing. Yeah, they just had a TV crew come in and interview me, ask me a bunch of questions about student loans, how to get them paid off, how to minimize them whenever you're in college, and it was a lot of fun.
That's good stuff. And so that interview led to us thinking, well, we'll create a couple of segments here on the program to talk about that. But I'm going to read a few sentences from this op-ed piece in the Wall Street Journal from about 2 weeks ago that describes it as the taxpayer con of the century. And this has sort of been my personal viewpoint for quite some time. And it talks about the notion of there are two entities that are at fault that involve the rapid, dramatic increase of student loan debt in America today. And they are none other than the government and the colleges that are providing education to the youth of America. So here's the sentence that I think summarizes up pretty well, and we'll give you a couple more items. As the loan limit increased over time, now $57,300 a year for independent undergrads and $31,000 per year for those dependents on their parents, colleges raise their prices to sop up more federal largesse. It doesn't matter to the schools if their philosophy grads work as baristas. The notion of writing off student debt is just a wealth transfer like none other to the academia. Here's some more stats to consider. About 1/4 of all college grads earn less than $30,000 a year. 1/4 of all college grads. 1 in 7 makes less than the poverty line. The average borrower, this is more in the article, the average borrower who completes a master's degree in film at NYU owes $113,180 and makes a mere $30,581 3 years after graduation. So what's the problem there? The problem is always the combination. Government and institutions working together?
In
Cahoots?
tandem? Yeah.
I don't know. Okay, one does one thing, one does the other. How else do you explain where the cost of education has literally been double the rate of inflation for the past 10, 15 years?
Yeah, I mean, it's gone up tremendously over the last couple of years. And just to put those numbers into perspective, making $30,000 a year, that's roughly $15 an hour.
Right.
So, I mean, that's assuming that you work 40 hours a week for 50 weeks. Yeah, that comes out to be about $15 an hour. So it's not, these are not really paying off, if you will.
Many folks need to really be thinking it through. And again, though, there's been this sale, if you will, of you have to go to college in order to achieve success in America. And I think that's shameful. And I think we're already seeing the implications of that, where we have a generation saddled by student loan debt. Meanwhile, you have some very lucrative careers on the trade side of things, or on the pilot side of things, that there's nobody there to fill them.
Yeah, I mean, you're taking a look at trade schools. Trade schools can take 2 years to 18 months to get through, and they're talking about paying more than $30,000 a year, and it's significantly cheaper than $50,000 a year in debt.
I assure you that you're paying your electrician more than $15 an hour.
Yes, I am. I'm doing a little bit of renovations at the townhouse, and I can assure you, yes,
more than $15 an hour. So anyway, there's our digression. Sorry, didn't mean to kind of get a little bit too philosophical on that one. But at the end of the day, I think it does underscore the notion that a student loan really is debt.
Yes.
At the end of the day, it's debt that you are taking on. I know a lot of people think of it, it's an investment for my future and things like that, and that's great. And don't get us wrong, we're not sitting here and saying that it's not a good investment for many folks to make. But at the end of the day, you have to understand that it is in fact debt. So what's some of the things that make student loan debt a little bit more unique than other kinds of debt?
Well, so a couple things. One, you didn't purchase an asset. So you have nothing to sell back. If you something happens in life where finances start falling apart and you really need to pay off this debt, you have nothing to give back. You're stuck with the debt. And then to compound that a little bit farther, not only do you not have anything to sell, you can't get rid of it. So let's say, you had a mortgage, you had a car payment, and you couldn't make those payments. The bank would come and take the car, they would take the house, and you would file for bankruptcy. Well, if you file for bankruptcy and you have student loans, those student loans aren't going anywhere.
It makes for, in essence, the security of the loan, if you will, right? Because to your point, if I borrow student loan debt, I don't have anything to show for it, but it's a great deal as a lender because you can never get out from under it.
Right. And then to take it, one step farther, because there's no asset backing it, we have seen the interest rates typically have been higher than other debts. So, you take a look at what mortgages were. Well, now they're up a little bit more.
Right.
Take a look at what mortgages and car payments, the interest rates on those, and you take a look at the interest rates on student loans. They're typically higher than what people, higher than the other two.
Well, and certainly, meant to poke a little bit of fun at writing off student debt, but there's certainly some good programs for folks to pursue careers that aren't those highly paid careers. But the problem is that these programs that are set up to help get student loan forgiveness don't work very well.
No. So the numbers that I was looking at, it was, I believe, November of 2022, of everyone that had applied for student loan forgiveness, only 2.1 had actually been accepted.
Yeah.
So
Yeah, we need teachers, we need social workers. We need all of those occupations that don't necessarily pay a high level of income, and the student debt forgiveness in those cases certainly has some merit. But if the program doesn't work, then maybe the solution is let's fix the current program before we then embark on a totally different approach of we're just going to wipe everything out, or we're just going to take and wipe out all kinds of student loans across the board. I don't know if that is the right solution, because as we've seen, you've got to be much more tailored in how you approach this issue.
Well, and also if you just wipe out all student loans, it doesn't really fix the problem going forward. You're still having college kids graduating with more and more debt today, just because the money supply for college is increasing.
Some of these colleges that have massive endowments, some of these schools have massive endowments, they really should be held accountable to utilize that money to help out kids that can't afford to go to school.
Yeah.
Anyway, that we're getting too philosophical. Let's stay on the pure numbers and cents, or dollars and cents side of this, if you will. To contrast student loans, I guess, a little bit with credit cards and how that would play out for the individual.
Sure. So a lot of times we get asked, should I use credit cards instead of taking out student loans? And the answer is no. Both of them have their places and both of them have their uses, and they're different uses in different places. So credit cards, for example, interest rate on those is around 20%. Student loans currently sitting around 10%. So definitely don't want to be, taking out higher interest rates if you don't have to. On top of that, the way credit cards work is you normally have a max that you can spend, and then you have to pay down in order to have access to more. So if your max is $20,000 and you're at the $20,000 limit, you can't use the credit card anymore until you pay it down. Student loans don't work like that.
Just keep getting another student loan.
Exactly.
Right,
You'll never run out. And then whenever you graduate, it's a giant snowball that you didn't realize you had.
Well, it's really it's a dramatic issue, because student loan debt now more than credit card debt.
Yes.
So it's a bigger issue for many Americans, and I think it's important to make sure that you think about it in terms of what it really is. We're going to continue this conversation on student loans, student debt in this graduation season coming up after the break here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Talking a little bit about student debt, student loans, all things during the course of this graduation season. Welcome, of course, to Dollars and Cents. We're Central Florida's longest running radio program, coming to you on a host of radio stations throughout the region. My name is Joel Garris. I'm joined with me today by Garrett Fields, one of the fellow certified financial fiduciaries at Nelson Financial Planning. Welcome again to the program, Garrett.
Thanks for having me.
This is the conversation that we're having on the program today is sort of an offshoot of a television interview that you did last week or the week before. I forget which one, but crew came in and had an opportunity to kind of talk about this.
Yeah, crew came in, interviewed me for about 30, 40 minutes, and so we decided it was a lot of good information, so why not turn it into a radio show and present it to y'all?
There you go. Excellent stuff. So we were talking about the difference sort of between credit cards and student loans. Sometimes people say, oh, I'm going to use a credit card to pay for some schooling. That's really not a good idea. And explain, if you will, why that's the case.
No. So just to recap, we're going over the difference between student loans and credit cards. And yeah, I mean, credit cards interest rates are typically higher than student loans. I mean, credit card interest rates, like we said, are at 20%, where student loans are at 10%. So you don't want to be paying a higher interest rate if you don't have to. On top of that, a credit card has a max. So it is going to, keep you out of some trouble because if you can only spend up to $20,000, you have to pay that down before you can spend more. Where with student loans, they'll let you spend as much as you want.
As much as you're willing to sign on to, unfortunately. Yeah.
And so whenever you look at it like that, credit cards really should be used for every day, every week, every month purchases. Something that you know that you could have paid cash for anyways, and at the end of the month, you know that you're going to pay it off. That's stuff like gas and groceries. Student loans are more for, obviously, schooling. Bigger ticket items because they have a little bit lower interest rate. And just to kind of give you an example of what the differences could be, if you have a $10,000 on a credit card with a 20% interest rate, that's going to, assuming that you're paying the minimum, that's going to be about $23,000. It's 50% interest that you're going to pay. As opposed to $10,000 in student loans at a 5% interest rate, that's going to end up being $12,700 roughly, which is about 21% interest. So significantly different numbers there, and that's kind of why you don't want to use credit cards if you don't have to pay students.
And that's probably just generally good advice anyway.
Yes.
Is to stay clear of it. So let's say, I'm graduating, I've got student loans, the water's under the bridge. What are some of the things that new graduates should really focus on if they've got student loans? I think you've got 3 or 4 points that I think are pretty valid in this situation.
Yeah, so first, kind of the most important is take an honest look at your financial picture. One of the things whenever clients come in and talk to us, and we typically start the conversation with debt, we have to single out student loans and say, hey, do you have any student loans? Because some people don't even consider them debt. Right. They'll go through their debt and say, oh, any student loans? Oh, yeah, I have those as well.
Okay, 80,000 in student loan debt. Don't worry, they're in forbearance. We're going to talk about that one a little bit later in the program. But yeah, it just gets ignored, if you will.
Well, yeah. and that's the thing is whenever it gets ignored, people don't understand the actual numbers behind it. So go look at a statement. In order to understand your full financial picture, you have to get concrete numbers. So go get a statement, go pull the number offline so you know how much debt that you're actually in.
And to your point, which I think one of the things that you always bring up is you got to treat this like you would any other loan. Get a statement on it, or treat it. Think of it almost like a mortgage, because in a lot of ways it is.
Correct. Yeah. I mean, it's actually almost worse than a mortgage because you can't get rid of it.
And the interest isn't tax deductible, or it's very limited in terms of the tax deduction these days. Yeah.
But yeah, the next is treat it like a mortgage. I mean, you need to budget to pay for this first, not I will put whatever I can towards it at the end of the month. This needs to be priority number one, and this needs to get paid off almost above everything else, because again, that's the only way you're going to get rid of it is actually paying it off. So treat it like a mortgage, treat it above a mortgage, make sure you get that paid off. And then third, go talk to a professional. We understand these things are tricky. We understand that you don't necessarily know all the answers, and we can help you find those out. So go talk to a professional. And then third, fourth, get a game plan. Put together on a piece of paper times and dates that you want things to pay it off by, and then follow that plan. Now, we also understand that plans get edited and changed as things go along, but as long as you have a plan that you're following and you know where you're headed, that's going to pay dividends down the road.
And so there's some specific strategies that I think it's important for folks to consider when they've got student loans. So what are some of those strategies that we encourage folks to follow?
Sure. So first, make sure you refinance. You might be eligible to refinance, and why pay a higher interest rate than you have to? That's the easiest way to pay the least amount of money possible. It's just by going into the bank saying, here's my interest rate, can you get me a lower interest rate? With that being said, make sure you calculate closing costs and all that stuff into it as well, but that's the easiest way to pay the least amount of money. After you've refinanced as much as you can, do the debt snowball. This is where you line up your student loans in order from smallest to largest. You want to pay the minimum on all of them, but the smallest you want to attack the hardest. So anything that you have left over, throw towards the smallest. That's going to get paid off the quickest. That's going to be the best win. That's going to be good emotionally. It's going to be good financially.
And that's why it's important to know what you owe and know each piece, because every semester you're getting a new loan, and so it's important to sit down with the actual numbers, create sort of that spreadsheet so you can come up with this debt snowball strategy to try and eliminate those student loans over time.
If you don't know where step one is, you're not going to be able to take step 2 and 3. So yeah, getting concrete information on step 1. And also, the reason that the debt snowball is important is because this is a marathon. This isn't a sprint. So paying off those first couple to get you, feeling good is going to be key, because this is going to be draining. It's not going to be an easy process. And then fourth, and this is the one that's probably going to get some backlash, is you might have to find a second job or switch jobs. You went to school for a college degree so that you can go work. Now you kind of have to use it in order to get out of this financial picture.
Well, and it's a great time. It's a great environment to maybe seek that out. So that's something that you should also be thinking about. Is oftentimes if you start someplace you don't necessarily see that upward mobility. Changing employers is a good way to maybe accelerate that. So I know there's always a hesitancy to do that, but the reality is that sometimes you have to do that. And in order to re-up, if you will, what your income might be at. Particularly a great opportunity to kind of be thinking that way in today's world, because of the demand out there on the employer side. The employees sort of have a little bit more power than they typically have had in years past.
A little bit more negotiating leverage.
Correct.
Yeah,
Correct. Absolutely. Absolutely.
How short the labor market is. Yeah, so that might be something that you have to do, and I understand that doesn't necessarily sound pleasant, but these debts aren't necessarily pleasant. So sometimes you have to do unpleasant things to get them paid off.
So as we got, looks like we got a couple of minutes left in the program. So let's talk about kind of forbearance and the mystery behind that, because I think people think that, if my loans are in forbearance, then out of sight, out of mind. But that's probably a bad strategy.
Yeah, no. So forbearance is whenever your student loans are pretty much in freeze. So they're not accruing any interest and no payments are due. And this is a slippery slope. Anytime you tell people no payments are due, they think, I don't have to make any payments, or I shouldn't make any payments, and that's not necessarily the case. Being in forbearance, there's a couple strategies we'll probably go over in the next segment, but yeah, this is an opportunity.
Yeah, we'll save that for a future program, because I think that is important. We're going to wrap it on up and get on out of here. Thank you all for listening to the program. Garrett, thanks as always for joining us, and we'll be back next week here on Dollars and Cents.